Welcome back. Let's continue with the accounting class. Week 2.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to finally generate some income for Rebecca Park and her Relic Spotter company. We'll go through a number of revenue and expense transactions for Relic Spotter and see how they performed in their first 6 months of business. Without further ado, let's get started. In a prior video, we did the first 14 transactions for this startup company. Now we'll resume the case with transactions related to revenues and expenses. Some of the transactions will be summary entries to record 6 months worth of activity in one journal entry. As we did last time, we'll record journal entries and post to T accounts for each transaction. After the transaction, you should pause the video and try to do the journal entry. Make sure you think about what accounts are involved, did they increase or decrease, do we debit or credit, and then resume the video to see the answer and the explanation. Transaction 15. In a search for new revenue opportunities, Park initiated an unlimited rental arrangement with the Penn Antiquities Club on December 1st, 2012. Under this arrangement, the club paid Relic Spotter $1,200 cash up front for unlimited rentals over the next year.
Debit cash.
For this transaction, Relic Spotter is receiving $1,200 of cash. Cash is an asset. We increase an asset with a debit, so we're going to debit cash for $1,200. Now we have to look for the credit. So we're getting the cash, and now we're obligated to provide rentals over the next year. That obligation is a liability, and it should be called something like unearned rental revenue. Liabilities are increased through credits, so we're going to credit unearned rental revenue for $1,200.
When do we get to recognize the revenue? We have the cash. We have committed to allowing the club to rent units whenever they need them. Isn't that enough to call this revenue?
No, committing to provide the rentals is not enough to be able to recognize the revenue. We have to earn the revenue by delivering the service. And the service here is providing unlimited rentals over time, which means we're going to have to wait until time passes before we can recognize the revenue and record this on our income statement. Then we post this to T accounts, so we add something on the debit side of cash, so we increase cash from this transaction, and we create a T account for unearned rental revenue, which has a credit balance. Transaction 16, for the 6 months ended December 31, 2012, rental revenues on the metal detectors totaled $124,300. Most of the rentals were paid in cash immediately. However, as an initiative to reward repeat customers, Park allowed a select number of frequent renters to charge their rentals to be billed later. As of December 31, 2012, $4,200 was outstanding under this plan. To do the journal entry for this one, we have to recognize that there were 3 accounts involved. We got rental revenues of $124,300. We have an accounts receivable of $4,200. That's what the customers owe us under the frequent renter plan. And the rest of it we received in cash. So the difference between $124,300 and $4,200 is $120,000. Anytime we receive cash, we debit it, so we debit cash for $120,100. We also have these accounts receivable, which are an asset. We make assets go up through a debit, so we debit accounts receivable $4,200. Remember, we always use the term accounts receivable for money owed to us by customers based on providing them goods or services in the past. Now we're looking for the credit part of the journal entry, and what we have left to do is record the rental revenue. Revenue accounts are credit balance accounts, so to increase revenue, we credit rental revenue, which increases revenue and increases stockholders' equity by $124,300. Another way to look at this is that Relic Spotter recorded $124,300 of revenue, of which $120,100 was received in cash, and $4,200 has not yet been received in cash, but hopefully will turn into cash soon in the coming months.
Same question as before. What happens if we don't collect the cash? It doesn't seem kosher for them to book all that revenue with no guarantee they'll get the cash.
Same answer as before. For now, we're assuming that the company will collect all the cash, but later on, we'll see how companies have to estimate how much cash they won't collect, and then make adjustments for this on their income statement and in the balance of their accounts receivable. So just hang on until later in the course. To post this one, we add another debit to the cash account, so another increase in cash. We create an accounts receivable T account with a debit balance, and we create a T account for rental revenue, which has a credit balance. Transaction 17. During the period between July 1st and December 31st, Park purchased $40,000 of sundries inventory, of which $38,000 had been paid in cash, and $2,000 was still owed at December 31st.
Debit 38K, debit
So for
account
this journal
payable
entry,
2K.
we're paying $38,000 of cash. We
Inventory.
credit cash for $38,000 to make
Oh,
the
paid,
asset
no
go
mind,
down.
sorry.
We're receiving inventory. Inventory is an asset. Assets go up with debits. So we debit inventory for $40,000 to recognize the inventory that we've received. So we're still missing one part of this, and that's the $2,000 that we still owe at December 31. If you remember from a prior video, when we owe money to a supplier based on getting shipments of inventory, we call it accounts payable, which is a liability. We make a liability go up with a credit, so credit accounts payable $2,000.
We're cool with this one, but thank you for checking.
We need to post this transaction, so we add a credit entry to the cash account. We add a debit to the inventory account, so now there'd be $42,000 in inventory. And a credit to accounts payable, now the balance would come back up from 0 to $2,000. Transaction 18. Relic Spotter recorded sales of sundries totaling $35,000 for the 6 months ended December 31, all received in cash. The journal entry here is very straightforward. We're receiving $35,000 of cash, so we debit cash $35,000 to make that asset go up.
Revenue.
We've made a sale. We delivered sundries. We got cash. It meets both criteria. We get to record revenue. Revenue is a credit account, so we make revenue go up with a credit to sales for $35,000.
We are not cool with this one. Where is the inventory? If we sold sundries, or whatever you call them, then our inventory should go down.
Excellent question. This journal entry is only dealing with the revenue part of the transaction, where we record the cash and the sales revenue at the selling price. We'll deal with the inventory part of this transaction in about 15 seconds. Let's post this to T account. So we post a debit to the cash account and create a sales T account to keep track of revenue from sundry sales. Transaction 19. The original cost of these sundries was $30,000.
Expenses.
In this journal
Inventory
entry, we're going
minus
to take care of the
30K.
inventory part of the sundry sales transaction. So if we sold sundries, our inventory went down. Inventory is an asset. We make an asset go down with a credit, so we're going to credit inventory for $30,000. Our debit here is going to be something called cost of goods sold, which is an expense. This is what we call the product cost when we make a sale. The original cost of the inventory becomes an expense called cost of goods sold that we match with the revenue that we get from selling the sundries. So we debit this expense, cost of goods sold, for $30,000, which then will reduce stockholders' equity.
Do these last two journal entries always have to go together? I mean, anytime you record revenue in an entry, do you have to record COGS in another entry?
Please also tell me why the revenue and the COGS were different dollar amounts.
What's COGS?
Yes, these two journal entries are like the salt
Do these
expense called cost of goods sold that we match with the revenue that we get from selling the sundries. So we debit this expense, cost of goods sold, for $30,000, which then will reduce stockholders' equity.
Do these last two journal entries always have to go together? I mean, anytime you record revenue in an entry, do you have to record COGS in another entry?
Please also tell me why the revenue and the COGS were different dollar amounts.
Yes, these two journal entries are like the salt and pepper of accounting. They always go together. Anytime you sell inventory, you need one entry to record the revenue and the cash we're going to collect at the selling price, and you need a second entry to record the reduction in inventory and cost of goods sold expense at the original cost. And we hope that the revenue is greater than the cost of goods sold because it means we've been able to sell our product at a markup over cost. In other words, we've been able to earn a profit on our product. If it's not the case, well, then you don't have to worry about doing these journal entries much longer because you won't be in business. We post this to T accounts by reducing the inventory account through a credit entry in the T account, and we post a debit to a cost of goods sold expense T account. Transaction 20. Finally,
Finally, I think the word finally may be my favorite word in the accounting language.
Ha ha. Let's try that again. Relic Spotter's 2 employees were paid wages of $32,000 total during the 6-month period and parked through a salary of $50,000. For the journal entry, we paid $82,000 in cash total, so we credit cash for $82,000 to reduce the cash account. The debit is going to be an expense for the employees working for us. Now, these employees would be period costs, so we're recognizing an expense as they work for us. We're going to debit salaries and wages expense for $82,000 to recognize this period cost, which then in turn will reduce stockholders' equity as expenses always do. Then we post this to T accounts, so yet another credit to the cash account, and we create a salaries and wages expense T account with a debit balance. Now it's the end of Relic Spotter's fiscal period, so we're going to close the books to any more transactions with the outsiders. The next step on the accounting cycle will be to do an unadjusted trial balance, which makes sure that everything that we've done so far during the fiscal period has been okay. There have been no math mistakes or transposition errors. So I'm going to bring up Excel and show you how to do this. I've been showing you the T accounts one by one, but here's what they would look like all on the same page. You'll notice that there are some T accounts which have nothing in them yet. These are things that we're going to work on in a later video when we talk about adjusting entries. But for all the other T accounts, what you'd want to do is draw a line and come up with a balance for each account. So we have $78,800 in cash, $4,200 in accounts receivable, $103,000 in land, and so forth. Then you carry over all the account titles to another page and create a column for debits and a column for credits. You put in the balance of each account and then just add up the columns. And you can see that we have $536,500 of debits. We have the same amount for credits. So we know that we've done everything correct so far because our debits equal our credits. And now we're ready to go on to the next step in the accounting cycle, which will be adjusting entries. Wow, there's nothing more thrilling than watching somebody work through Excel on video. Sorry about that, but that seemed to be the most expeditious way to show this part of the accounting cycle. Plus, if you're going to learn some accounting, you got to do some Excel now and then, right? So in the next video, we're going to talk about adjusting entries, which will get us one step closer to putting together financial statements. I'll see you then.
See you next video.
Cool. Hey, welcome back to weekend. The weekend. Oh, thank God it's Friday. And your FA classes. What's FA? Financial analysis? Financial accounting. It is not very exciting, if I have to say.
Hello, I'm Professor Brian Boucher. Welcome back. In the next 2 videos, we're going to talk about adjusting entries. These entries help to get the books in shape so that we can prepare financial statements. In this video, we'll talk about adjusting entries conceptually and go through some examples. And in the next video, get some practice to do these journal entries. Let's get started. So far, we've looked at the part of the accounting cycle where a company is analyzing transactions, doing journal entries, and posting to T accounts during the fiscal period. And at the end of the period, the company does an unadjusted trial balance to make sure that there are no mistakes made so far. Now we're going to move on and take a look at the next step in the cycle, which is adjusting entries. Adjusting entries are internal transactions that update account balances in accordance with accrual accounting prior to the preparation of financial statements. By internal transactions, we mean that we're not doing any more transactions with outsiders. This is just the accountant sitting at his or her desk doing journal entries to get accounts up to date to do financial statements. I guess the way to think about this is if a company's fiscal period ends December 31st, everyone else in the company is going to leave at 5 o'clock to go out for New Year's Eve parties. But the poor accountant has to stay behind and do these adjusting entries before the company can get ready to do its financial statements for the end of the year. There's two big categories of these entries. The first are called Deferred Revenues and Expenses. In this case, we're updating some existing account balance to reflect its current accounting value. This happens when there's been some kind of cash flow in the past, but we need to record revenues or expenses now. The other big category are Accrued Revenues and Expenses. Here we have to create some new account balances to record some previously unrecorded assets or liabilities. This will be situations where we're going to record a revenue or expense now, and there'll be some kind of cash flow in the future. So don't worry, I'm going to go through examples of each of these types of adjusting entries so you can see exactly what we mean by them.
Do any of these adjusting entries involve recording cash now?
No, adjusting entries never involve cash because these are purely internal transactions. We're not doing any transactions with anyone outside the business at this point, so there's no more cash coming in and there's no more cash going out. The first category we're going to look at are deferred expenses. So as our poor accountant sits at his desk on New Year's Eve night and watches his colleagues from sales and marketing and operations and human resources happily leave the company to go celebrate New Year's Eve, the accountant asks himself, are there any assets that have been used up this period and should be expensed? The accounts that we'll see here are generally called prepaid accounts, like prepaid rent or prepaid insurance. Depreciation and amortization are also examples of a deferred expense, but we'll talk more about those later in the video. But let's think of something like prepaid rent. We've paid cash in advance of occupying the space, so we create an asset called prepaid rent. But then as time goes by and we've occupied the space, we have to recognize the cost of the rent for the time that we've occupied the space. So we're going to do an adjusting journal entry where we debit an expense to recognize the cost of the rent that's been used up over time, and we're going to credit the prepaid asset to reduce the balance to how much that's still prepaid, if any, at the end of the year. Next, we have deferred revenues. So as our accountant starts receiving all sorts of text messages from his friends saying, hey, when are you going to come out to the New Year's Eve party? It's getting late. The accountant has to put away his phone and think to himself, are there any liabilities that have been fulfilled by delivery of goods or services that should be recognized as revenue? So the accounts involved here will be things like unearned revenues or deferred revenues. So what's happened in this case is we've received cash prior to providing goods or service. Now that time has gone by and we've earned the revenue, the adjusting journal entry will say credit revenue to recognize the revenue that we've earned over time, and debit the unearned revenue liability to reduce the obligation because we fulfilled part of the obligation by delivering the goods or services over the time period.
Why would this be an adjusting entry? Wouldn't you know when you had delivered goods, and then just record this entry then?
Yeah, if we had delivered some goods, we probably would have recognized revenue when we delivered the goods. But these examples are about providing some kind of service over time. And in this case, we just do an adjusting entry to recognize all the service provided over the period, as opposed to doing an entry every month or week or day or hour or minute or second. Next, we have accrued expenses. So as our poor accountant decides to turn on the TV to watch something like New Year's Rockin' Eve so he can hear some of the music in the background that he's missing at all the parties, he has to ask himself, have any expenses accumulated during the period that have not yet been recorded? These accounts are all going to be payable type accounts. What's going on here is that we've incurred some expense over time, but we haven't yet paid for it in cash. So the adjusting journal entry we need to make is to debit an expense to recognize that expense and credit a payable liability to show that we have an obligation to pay for that expense. For example, if employees have worked for us but we haven't paid them yet, we have to debit a salaries and wages expense to recognize the cost of the employees working for us, and then credit salary and wages payable to show the liability that we have to pay our employees some point in the future. Finally, we have accrued revenue. So as our poor accountant looks at the TV to watch the ball drop at Times Square, he hurriedly asks himself, have any revenues accumulated during the period that have not yet been recorded? So he can do his one more set of adjusting journal entries. The accounts we're talking about here are going to be receivable accounts like interest receivable or rent receivable. An example would be if we loaned someone else money, time has gone by, so now they owe us interest. We would do a journal entry to credit revenue for the interest that they owe us, and then we would debit a receivable asset like interest receivable to show that we have an asset for the amount of cash that we're going to collect in the future. So this adjusting journal entry allows us to recognize revenue that we haven't recognized so far, and then show that we have an asset for the cash that we expect to collect in the future.
How can revenues be accumulated with you not knowing about it? When revenues are earned and realized, you should record the entry. Why is this an adjusting entry?
Again, these examples are about providing a service over time as opposed to delivering specific goods. And since it only matters that the revenues show up in the books when we put together financial statements, it's just easier to do the adjusting entry once at the end of the period instead of doing it every month or week or hour or minute, or you get the idea. Finally, we're going to talk about depreciation and amortization, which are just examples of deferred expenses, but there's a lot more to them, so I wanted to give them their own couple of slides. The goal of depreciation and amortization is to allocate the original cost of a long-lived asset over its useful life. What we want to do is match the total cost of the asset to the revenues it generates over its period of use. If you remember back in the introductory video, we looked at Dave's car transport service. Dave had bought a truck that he intended to use for 48 months. Instead of recognizing the cost of that truck as an expense in the first month, we spread the cost out over 48 months through depreciation to try to match the cost of the truck to the revenue we think it will generate in the future. Now, some terminology here. Tangible assets, which are physical assets like buildings or equipment or truck, we're going to call this process depreciation. For intangible assets, which are abstract assets like trademarks or customer lists, which we've acquired in an acquisition, we're going to call this process amortization. But the process is going to be very similar, even though the terminology is different. Now let's talk about the accounting procedure for depreciation and amortization. Starting with depreciation. Depreciation is not deducted from the tangible asset account. So in other words, if you were taking depreciation on a truck, you wouldn't deduct it from the truck account. Instead, the depreciation is going to be recorded in a contra asset account called accumulated depreciation. A contra asset is denoted by XA in parentheses, and it has a credit balance, which means that contra assets go up with credits and down with debits. I think contra is a Latin word which means something like it has the balance on the opposite side of where you'd expect the balance to be based on where it is on the balance sheet. In other words, assets normally have debit balances, so they're increased with debits. A contra asset would have a credit balance and be increased with a credit because essentially a contra asset is keeping track of reductions in a companion asset account. Then what we'll see is when we put together the financial statements, the accumulated depreciation will be subtracted from property, plant, and equipment on the balance sheet to get something called net book value. Amortization is often deducted directly from the intangible account. So if you were amortizing a trademark, you would deduct it directly from the trademark account. However, nowadays there are companies that have fairly large intangible assets, and they've started to use accumulated amortization accounts as well. So that's just another type of contra asset where the accounting works just like accumulated depreciation. But I think the most common treatment you see is that the amortization just comes directly out of the intangible asset account.
Where do contra assets fit into the balance sheet equation? Why do they have a credit balance if they are assets?
I admit that it's hard to get your head around this notion of a contra account. Let me pull up the Super T account to show you where a contra asset sits on the balance sheet. So the contra asset is on the asset side of the balance sheet, but it has a credit balance. That means an increase in a contra asset would reduce total assets. The way to think about it is a contra account is keeping track of the decreases or reductions in a specific asset account. It's almost like an expense. Expenses sit on the shareholders' equity side of the balance sheet in retained earnings, but they have a debit balance. That means an increase in expense reduces retained earnings. And in fact, an expense is just a contra shareholders' equity account. So you've actually seen this before, and you're going to see a lot of it again, and as you see it over and over, I think it'll become more intuitive to you.
And why not just deduct depreciation from the regular asset account?
Excellent question. When we get to the video where we put together a balance sheet, we'll see that the common format for reporting property, plant, and equipment is to show the original cost of the property, plant, and equipment separate from how much it's been depreciated over time. And in order to provide that format, we have to keep track of this accumulated depreciation in a separate account. To calculate the amount of depreciation expense every year, almost every company uses a method called straight line depreciation. Under this method,
How would you know
the
the useful
depreciation
life
expense
of
is
it,
equal
though?
to the original cost of the asset minus its salvage value, all divided by its useful life. The salvage value is what you think the asset's going to be worth when you're done using it.
It's
So in the
so
numerator, we're
objective.
taking how much of the asset
That's
cost
subjective.
you're going to use up. And then the useful life is the number of periods you expect to use the asset. So under straight line depreciation, the amount of the depreciation expense is going to be the same for each year of the asset's life.
Are there other methods of depreciation? Why do almost all companies use straight line
It's
for their
easier.
financial statements?
Yes, there are accelerated methods of depreciation where you recognize higher depreciation in the early years of an asset's life and then much less depreciation in later years of an asset's life. These methods are used for tax purposes, which we're going to talk about much later in the course. My conjecture is that most managers like to use straight line depreciation because it produces nice, smooth earnings. If you use accelerated depreciation, then your earnings will be more volatile depending on whether you have a lot of new equipment, which is got high depreciation, or a lot of equipment which is later in its life, which has much lower depreciation.
Who determines the useful life and the salvage value? Is it a central government agency?
No, for financial reporting purposes, there is no central government agency that dictates useful life and salvage value. Managers are supposed to choose the useful life based on how long they intend to use the asset, and then the salvage value will be a function of how long they intend to use it. So to see how this works, let's talk about a couple airlines. There's a major international airline which has a strategy of only flying pretty new state-of-the-art planes. They'll buy a brand new plane, fly it for 5 years, and then sell it to someone else. So when they choose their depreciation assumptions, their useful life is 5 years, and they have a very high salvage value. Now there's a major domestic airline that tends to fly their planes for 20, 30, 40 years. I'm not going to mention the name, but you probably know who it is. Their strategy, if they bought a brand new plane, would be to choose a useful life of 20 years, and then they would have a low salvage value as a result. So you could have two airlines buy the same plane and have different depreciation assumptions, but that's okay because the depreciation assumptions are supposed to match how the manager intends to use the plane, not anything that has to do with the physical life of the plane. So I think I've probably fully depreciated your energy at this point, so why don't we wrap up here? I'll see you next video where we'll do some more practice with adjusting journal entries. See you then.
See you next video.
Hello, I'm Professor Brian Boucher. Welcome back. This video is part 2 of our look at adjusting journal entries. Hopefully this sequel will be an Empire Strikes Back type sequel and not a Mannequin 2 type sequel. Anyway, let's get to it. Okay, let's do some practice with adjusting journal entries. I will give you a series of related transactions. Some of them will be cash transactions that happen during the regular operating period of the company. And then other times we'll look at the fiscal year end and then ask the question about whether there's an adjusting entry needed, and if so, what would it be? As always, the pause icon will appear if you want to pause the video and try to come up with the journal entry before I give it to you as the answer. Well, let's get started. On September 30th, BOC loans $100,000 to an employee at a 12% interest rate. This is a cash transaction that's happening during the fiscal period. BOC is loaning $100,000 cash. Cash is going down, so we credit cash for $100,000. The debit here is going to be an asset called notes receivable. It's a receivable because the employee owes us $100,000 of cash in the future. We don't want to call it accounts receivable because we only use that for customers, so we call it notes receivable. December 31. It's the end of the fiscal year, and no principal or interest payments have yet been made. Do we need an adjusting entry, and if so, what would it be?
No, because there's no transactions, right?
We do need an adjusting entry in this case because 3 months has gone by, and we haven't gotten paid any interest, but we've earned interest revenue. We've earned interest revenue because we've provided the service of having the money outstanding to the employee over the past 3 months. We have a contract where we're eventually going to get paid, so it meets both the earned and realized criteria. So we're going to recognize interest revenue. We recognize revenue with a credit. We credit interest revenue for $3,000. The debit is again going to be a receivable, and we're going to be specific here and call it interest receivable because the asset is that we're owed cash for interest. We don't want to call this notes receivable because we're only going to use that for the principal part, and of course we don't want to call it accounts receivable because we only use that for customers.
How did you come up with $3,000 as the amount of interest revenue?
Let me show you. We have $100,000 of principal and a 12% interest rate. Anytime you see an interest rate, you should assume it's an annual rate unless it specifies otherwise. So 100,000 times 12% is 12,000 of interest per year. But it hasn't been a year yet, so we take 12,000 times 3/12 because it's been 3 months, and we end up with $3,000 of interest for the 3 months. Now it's January 6th. The employee sends a check for 3 months of interest on the loan.
Don't do it because it's not fiscal year.
This is a cash transaction happening in the next fiscal year. We're receiving cash, so we're going to debit cash for $3,000 because we're receiving the interest receivable that was owed before. And if we're receiving the interest receivable, it's no longer receivable, so we need to get rid of that account. So we credit interest receivable to reduce that asset by $3,000 since we've now received the check. Next set of transactions. So it's December 31st. It's the end of the fiscal year. During December, employees earn $400,000 in salaries, but paychecks do not get issued until January 2nd. It's the end of the fiscal year, so we have to ask ourselves whether we need an adjusting entry. We do in this case because we've had employees work for us. Even though they haven't been paid, we have to recognize an expense for the amount of salaries that they earned during December. So we're going to create an expense, and we create an expense with a debit salary expense for $400,000. We haven't paid them cash, but we owe cash. We have an obligation to pay them for the time they worked. That obligation sounds like a liability, and in fact it is, so we credit salaries payable liability for $400,000.
What do you mean by earned salaries?
They've
I
done
thought
a
earned was
service.
one of the revenue recognition criteria. This is an expense.
Yes, earned is one of the revenue recognition criteria. And from the perspective of the employee earned salary revenue. The employee provided a service, they have an agreement to get paid, so it's revenue for the employee. And what is revenue for the employee is an expense for the employer, which is why this is salary expense. Now it's January 2nd, and the paychecks are sent to the employees. If we've sent checks, that means we've paid cash, so we're going to credit cash for $400,000. By paying the cash, we've gotten rid of the obligation to pay their employees, so we have to reduce the liability. We reduce liabilities with a debit, so we debit salaries payable for $400,000. Next series of transactions. On November 20th, BOC pays $10,000 for December's rent. So BOC's paid cash, so their cash has gone down, so we need to credit cash for $10,000.
Where's it?
The debit is going to be to an asset called prepaid rent. It's an asset because we're either going to get the benefit of occupying the space in the future, or we're going to get our money back. So either way, we create an asset called prepaid rent for $10,000 at this point. Now it's December 31st. It's the end of the fiscal year. Do we need an adjusting entry, and if so, what would it be?
There's no prepaid rent.
We do need an adjusting entry because December has gone by and we've occupied the space for the month of December. The prepaid rent is no longer prepaid, it's been used up. So we have to create an expense for the amount of rent that we've used up. We create an expense through a debit, so we debit rent expense for $10,000. Our rent is no longer prepaid, so we have to get rid of that asset. We get rid of an asset with a credit, so we credit prepaid rent for $10,000, which brings the balance down to zero. Next set of transactions, so it's June 30th. A customer pays BOC $60,000 for a 3-year software license. So in this example, BOC is a company that sells software. We've received $60,000 cash as BOC, so we need to debit cash for $60,000. But BOC hasn't delivered any of the software yet, so they can't recognize revenue. Instead, they have to create an obligation or a liability for their responsibility to deliver the software over the next 3 years. So we create a liability with a credit unearned software revenue for $60,000. It's now December 31st. It's the end of the fiscal year. Is an adjusting entry needed? And if so, what is it?
Use up some of the software license time, so
we do need an
credit
adjusting entry
assets.
because 6 months of that 3 years has gone by.
No,
And as time goes by, we get to recognize revenue for the amount of time that's passed. So we're going to credit software revenue for $10,000 to recognize 6 months worth of revenue. This in turn has to reduce the liability. We reduce the liability with a debit unearned software revenue for $10,000. So after this transaction, the balance in unearned software revenue would be $50,000, which is our obligation to deliver software over the next 2.5 years.
I know why the answer is $10,000, but maybe you should explain it for the other viewers.
Sure,
6
I'm
months
happy to explain how to
out
get
of
$10,000 for the
3
other
years.
viewers. BOC is going to earn $60,000 of revenue over 3 years. Assuming they earn it on a straight line basis, that's $20,000 per year. It hasn't been a year, it's only been 6 months. So 20,000 times 1/2 is 10,000, and BOC gets to book 10,000 of revenue for the 6 months. Next series of transactions, it's June 30th. BOC purchases a building for $500,000. The expected life of the building is 20 years, and its expected salvage value is $100,000. At this point, we have to account for purchasing the building, but we're not going to do any depreciation yet because we just bought the building. We paid $500,000 cash, so we credit cash $500,000. We received a building's an asset, so we debit building for $500,000. Now it's December 31st. It's the end of the fiscal year. Is an adjusting entry needed? And if so, what is it?
Use one, the depreciated.
We do need an adjusting entry to recognize the depreciation for 6 months. The format of the depreciation expense journal entry always looks like this. We debit depreciation expense to create the expense, and then we credit accumulated depreciation. Remember, accumulated depreciation is a contra asset account. That's where we're going to store up the depreciation over time. We're not going to directly deduct it from the building account, but instead we're going to put it in this contra asset called accumulated depreciation. And because it's a contra asset, a credit increases the account, increases the contra asset, which in turn is reducing total assets. Now we did 10,000 as the number. Where did we get that from? I've got that one on the slide. So the building originally cost 500,000 and the salvage value was 100,000. So we're using up 400,000 of value over time. We're doing it over 20 years. So that's 20,000 of depreciation per year. But it's only been 6 months, so we need to take the 20,000 divided by 2 to get $10,000 of expense for the 6 months.
What if your salvage value or useful life estimates are wrong? How can you possibly know what a building will be worth in 20 years, or even that you will use it for 20 years?
Both the useful life and salvage value are managers' best estimates at the time they buy the building of how long the building will last and how much it'll be worth when they're done with it. Like all estimates, they will almost certainly be incorrect. But at any point, if the manager gets better information, they can revise their estimates. So if they think they're going to use it longer or shorter than they originally thought, they could extend or reduce the useful life, and then just change the depreciation expense going forward. And then when they decide to sell the building, if it's not worth the salvage value, then we'll just book a gain or loss when we sell it, and we'll see this play out more later in the course. Okay, last set of transactions. It's December 31st. BOC still has an outstanding order for $300,000 of products that will be delivered and billed in January. Do we need an adjusting entry at this point? We do not need an adjusting entry at this point. We haven't earned any revenue because we haven't delivered any goods or services this year. We haven't collected any cash, so we don't have to account for any cash that we've received. So basically, there's no transaction yet. Everything's going to happen in the future, so there's no adjusting entry needed at this point.
Okay, so we can't record revenue yet. But is there any way that we can let people know about this order?
Yes, companies can always voluntarily disclose additional information that they're not allowed to recognize in the financial statements. For example, companies often disclose the order backlog in their annual report. The order backlog is a disclosure of the number of outstanding orders the company has that haven't gotten to the point yet where the company could book revenue from them. So the investors can use this disclosure to find out about upcoming orders even though they haven't yet shown up on the balance sheet or the income statement. Here's a quick graphical overview of adjusting entries before we wrap up the video. Think about a timeline where we have cash transactions that happen at different times than we recognize revenues or expenses. The deferred revenue and deferred expense occur when we have a cash transaction before we recognize a revenue or expense. So if we receive cash before we can book revenue, we need a liability, an unearned revenue liability, to bridge the gap. Or if we pay cash before we record an expense, we need an asset, a prepaid asset, to bridge the gap. For accrued expenses and accrued revenue, now the expense and revenue recognition is happening before the cash transaction. If we have to recognize an expense before we pay cash, we need a liability to bridge the gap, and that liability is going to be a payable. If we book revenue before we receive cash, then we need an asset to bridge the gap, and that asset is going to be a receivable. So all of the adjusting entries that we talk about are going to fit into one of these four categories. Now that we've done examples of all the possible types of adjusting journal entries, I can't think of anything better to do than do more practice with them. And that's what we'll do in the next video when we continue the relic spotter case. I'll see you then.
See you next video.
Hello, I'm Professor Brian Boucher. Welcome back. In this video, we're going to take what we learned about adjusting entries and apply them to the relic spotter case. Let's get started. In prior videos, we did all 20 transactions that occurred during Relic Spotter's first 6 months of operations. Now it's 5 p.m. on the last day of the fiscal year, December 31st. We're not going to record any more transactions with outsiders. But before we put together the financial statements, we have to record the internal transactions or adjusting entries. As in prior videos, I want to try to record the journal entry and post a T account for each required adjusting entry. I will again put up the pause sign so that you can try the journal entry yourself before I reveal the answer. Transaction 21. When Park called her accountant on December 31st, 2012, she was pleased to tell him that the company had $78,800 in cash. By the way, before I go on, if we pull up the cash T account, added up the debits, added up all the credits, you could see that the balance is $78,800. That's not going to change because all of these adjusting entries will not involve cash. Anyway, back to the transaction. Park wanted to go out and celebrate, but the accountant reminded her that she needed to stay in to do adjusting entries. For example, even though it wasn't paid in cash, accrued interest on the mortgage was $4,900. The adjusting entry here is that we have to recognize interest expense that we've incurred by having the mortgage outstanding during the year. To create an expense, we're going to debit interest expense for $4,900, which is the number provided in the transaction. And we're going to have to recognize a liability because we have an obligation to pay the bank cash for this interest sometime in the next period. So we create the liability with a credit interest payable for $4,900.
What does the word accrued mean, and why is this an expense if the bank hasn't made us pay the interest yet?
Let me check my dictionary. Accrued means to accumulate, grow, or increase as interest on money. And that's exactly what happened here. The loan was outstanding for 8 months, and so the interest accumulated or grew or accrued for 8 months. Even though we haven't paid that interest in cash, we have to expense it because the money was outstanding during this period. So that interest cost is a cost of doing business this period, and we need to match that cost to the revenue we generated. So we need an expense, which we create through the adjusting entry. Then we need to post this to T accounts, so we create an interest payable liability. This will go on the balance sheet to show that we have this obligation to pay interest in the future at the end of the year. And we create an interest expense to recognize that one of the costs of doing business this period was that we've incurred interest costs. Transaction 22. The accountant said that depreciation needed to be recorded on the building. Park was confused by this because she received an unsolicited letter from a mortgage broker informing her that the building had increased in value to $120,000. Now recall that in transaction number 5, Park had renovated the building, bringing its original cost to $85,000. She also determined that the useful life of the building was 25 years with an expected salvage value of $10,000. So for the adjusting entry, remember the format that we use for depreciation expense. We debit building depreciation expense for $1,500. We debit the expense to create it. And then we credit accumulated depreciation. It's the contra asset where we're going to store up the depreciation over time. Now where we get the $1,500 is we take the difference between the original cost of $85,000 and the salvage value of $10,000. So that's $75,000 we're going to depreciate over time. Divided by 25 years of life would be $3,000 of depreciation per year. It hasn't been a year yet. The business has only been open 6 months. So we take half a year to get the $1,500.
The building was purchased in April and renovated in May. Why are we recording only 6 months of depreciation?
You are correct. Since we finished the building 7 months ago, we could have recorded 7 months of depreciation. But I chose to do 6 months because Relic Spotter's only been open for 6 months, and I'm trying to match the cost of the building with the revenue we generated. Plus, the math was a lot easier with 6 months rather than 7 months.
And what about the letter from the mortgage broker? If the building is worth $120,000, why are we depreciating it?
For non-financial assets like buildings, we use an accounting method called historical cost or amortized cost. What this means is that if the value of the building goes above what it's listed on the balance sheet, we never write it up. But if the value of the building drops below what it is on the balance sheet, we write it down. This is an example of the non-aggressive nature of accounting, where we tend to err on the side of objectivity or reliability. Because if we allowed managers to write up something that's hard to value like a building, there'd be too much opportunity for manipulation. So we only allow them to write it down in value. And I don't know what the specific principle is called in accounting, but we never rely on values from unsolicited letters from mortgage brokers, which is probably a life lesson that you should carry out beyond this course. We post this journal entry to T accounts. We create a T account for accumulated depreciation as a contra asset, it is a credit balance, and then a T account for building depreciation expense. Transaction 23. The accountant also noted that Park needed to record depreciation on the metal detectors. Recall that in transaction number 6, Park purchased $120,000 of metal detectors. She determined that they would only last for 2 years, at which time they'd have no remaining value. Journal entry has the same format as the last transaction. We debit metal detector depreciation expense to create the expense, and we credit accumulated depreciation to increase the contra asset where we store up depreciation over time. Where do we get $30,000 from? The metal detectors originally cost $120,000. They have no salvage value, so we're taking that entire $120,000, spreading it over 2 years to get $60,000 per year, but it's only been half a year, so the amount that we depreciate is $30,000.
So, why do you have separate accounts for building and metal detector depreciation expense, but you only have one account for accumulated depreciation?
You'll see why when we get to the video on financial statements. But as a little preview, what you'll see is when we do the income statement, building depreciation expense and metal detector depreciation expense are going to go into different parts of the income statement, so we need to keep track of them in separate accounts. But when we do the balance sheet, there's just going to be one line for all of the accumulated depreciation, so we can throw it all into one account. We post this to T accounts by putting another credit entry in accumulated depreciation and creating a T account for metal detector depreciation expense. Transaction 24. The accountant...
Wait a minute. You forgot the land. Don't we have to depreciate the land as well?
Thank you for reminding me about the land. There's a long-standing tradition in accounting where we don't depreciate land. We don't assume that land is systematically used up to generate revenue. So as long as the value of the land is at or above what it's carried on the balance sheet, we just leave it at its original cost. But if the value of the land dropped below what it was on the balance sheet, we would write it down to that value, but we wouldn't systematically depreciate it over time. That's why when we originally bought the land and building together, we had to separate how much of the value was from the land and how much was from the building. The amount of value from the building is hitting the income statement over 25 years as it's depreciated, whereas the value that's put in the land account will never hit the income statement as long as the value of the land stays at or above that level. Let's try this again. Transaction 24. The accountant continued. What about adjusting the software amortization account? Recall that in transaction number 8, Park paid the $2,100 3-year software license fee on June 30th. Because software is an intangible asset, we're going to use the term amortization instead of depreciation. So we're going to debit software amortization expense for $350. And then because it's amortization, I'm going to credit the software account directly to recognize the amortization. Where does the $350 come from? Well, we paid $2,100 for a 3-year license, so that's $700 per year of amortization. It hasn't been a full year, so we take half a year of that to get $350.
Wait, why do you reduce the software account directly instead of creating an accumulated amortization account?
Yeah, as I mentioned in a prior video, the historical tradition is that for amortization, You just reduce the intangible asset account directly instead of creating a separate
The special
accumulated
rules
amortization account.
for no
And
good
I think
reasons.
historically we've done that because intangible assets have not been that big of a deal on the balance sheet. But nowadays, more and more companies are starting to have larger and larger intangibles, and you will see more and more accumulated amortization accounts. But I wanted to show you the old-fashioned way because you still will see this practice quite a bit of just directly reducing the intangible asset account instead of creating an accumulated amortization, but you can see it either way. We post this one to T accounts. We directly reduce the software account with a credit, and then we debit a software amortization expense account. Wow, we've only done 4 of the 8 adjusting journal entries for Relic Spotter, and we've already recorded 12 minutes of video. I guess the virtual students have a lot to say today. So I'm going to end the video here, and then we'll pick up in the next video with the last 4 adjusting journal entries for Relic Spotter. I'll see you then.
See you next video.
Cool. So you're repeating a lot of the same info from before. Anyway, have a good weekend, y'all. See you next video.